Your uncle's not wrong. When you buy a stock, you're handing over real money for something whose price you can't predict, hoping it goes up. That's a bet. So yeah, on some level, buying stocks is gambling. But there's one difference between the two. One. And once you see it, you can't unsee it. Because it's the exact line between the people who slowly get rich doing this and the people who slowly go broke doing the same thing. So let's actually find that line. Here's the uncomfortable part most finance channels skip. The fear is reasonable. A casino and the stock market have real things in common. In both, you put money down now for an uncertain payoff later. In both, nobody knows what happens next. Not the guy on TV, not the hedge fund, not me. And in both, you can absolutely lose money you can't afford to lose. So if your gut says this feels like a slot machine, your gut is picking up on something true. Both are decisions made under uncertainty. Both are, in the plainest sense, bets. If the difference were just gambling is risky and investing is safe, that would be a lie, and you'd smell it. Investing is risky. People lose everything in markets all the time. So that's not the difference. The difference is hiding somewhere else. It's in the math. Let's start with the casino, because the casino is honest about what it is. Every game in there is built on one number. It's called the house edge. Take roulette. There are 38 pockets on an American wheel. You bet on one number, you get paid 35 to 1 if you hit. But your real odds of hitting are 1 in 38. Sit with that for a second. They pay you like it's 1 in 36. Reality is 1 in 38. That gap is the house edge, and it's about 5 cents on every dollar you bet. Here's what that actually means. If you bet $1 over and over, on average you get back about 95 cents. Not once. Every single spin. The expected value of your dollar is 95 cents. There's a name for this. It's called expected value. Basically what you'd win or lose on average if you did this 1,000 times. And in a casino, your expected value is always negative. Always. That's not bad luck. That's the design. Which leads to the brutal part. The more you play, the more certain you are to lose. A gambler can win tonight. A gambler cannot win over 1,000 nights. The math grinds them down. The house doesn't need to cheat. It just needs you to keep playing a game where the odds sit on the other side of the table. That's real gambling. Negative expected value, dressed up in lights. Now here's where the stock market splits off. And it's not a small split. It's the whole thing. When you buy a share of a company, you're not making a bet against a house. You're buying a piece of a business, a real one that makes something, sells it, and if it's any good, earns more money next year than it did this year. Think about what you own when you buy one share of Coca-Cola. You own a sliver of a company that sells about 2 billion drinks a day in basically every country on Earth and has been doing it for over a century. That sliver earns money whether or not you ever sell the stock.
So the table is completely different. A casino is what's called a zero-sum game. Actually worse. For you to win, the house has to lose, and the house made sure that almost never happens. But the stock market, over long stretches, is a positive-sum game. The pie itself gets bigger. Companies grow, the economy expands. Profits pile up year after year. Here's the number that proves it. Over the last century, the U.S. stock market as a whole has returned roughly 10% a year on average. Not every year. Some years it drops 30% and ruins your week. But on average, over decades, up and to the right. The expected value of owning a broad slice of American business over the long run is positive. Read that back against the casino. The gambler's expected value is negative. Time is his enemy. The long-term investor's expected value is positive. Time is his friend. Same activity on the surface, opposite math underneath. That is the line. That is the one difference. In a casino, you can never find a table where the odds favor you. In the market, that table exists, and you're allowed to sit at it. But, and this is the part that'll actually save you money, not everything that happens in the stock market is that positive expected value game. The market has 3 games running inside it at the same time, and they look identical from the outside. Same app, same tickers, same green and red numbers. Under the hood, totally different math. Game 1 is investing. You buy pieces of real businesses that earn money, and you hold them long enough for that growth to show up. Positive expected value. Time works for you. This is the table you want. Game 2 is speculation, short-term trading, trying to buy a stock this morning and sell it higher this afternoon. Now you're not really betting on the business anymore. You're betting you can outguess the person on the other side of the trade. This one's closer to skilled poker. It's not automatically stupid, but your edge only exists if you're genuinely sharper than whoever's selling to you. And most people trading against Wall Street's algorithms are not the sharpest player at the table. They just think they are. Game 3 is the one wearing an investing costume. Lottery ticket options that expire Friday. Meme coins your group chat is screaming about. Anything with heavy leverage where a small move wipes you out. Add up the fees and the odds, and the expected value is negative, which means, mathematically, it is the casino. It's just got a stock app skin on it. Here's the trap. Someone can walk into the market, the one place with a positive expected value table available, march straight past it, and sit down at Game 3. And then when they lose, they say, "See, stocks are gambling." No, you chose the slot machine when the good table was right there. So let's kill the myth for good. The difference between investing and gambling was never smart people versus dumb people. A gambler can be a genius, card counters are brilliant, and casinos still throw them out because even brilliance can't fix a table where the math is against you. The real difference is which table you choose to sit at. The gambler doesn't get to choose. Every table in the building is negative for him. That's the whole business model. You do get to choose. You can walk into the market and pick the one game where the odds actually till your way, owning real businesses over real time, and then just let it work. Or you can chase the flashing lights. Same room, your call. That's it. That's the line your uncle couldn't explain. Investing isn't gambling done smarter. It's a different game. The one where, if you pick the right table, the house is finally you. So next time someone tells you the stock market is just a casino, you can tell them the truth. It has a casino inside it. It also has the one table the casino would never let exist, where time and math are on the player side. The only skill that matters is knowing which one you're sitting at. If you want, I'll show you exactly how to find that table without needing to pick a single stock. That's the next video. I'm not going to tell you to smash anything. If this made the stock market make a little more sense, that's the whole point. See you in the next one.